Onramp's founder in residence, and also to your host and moderator for this evening's session. We're really excited about tonight's workshop because tonight's workshop is going to be all about the numbers. As you know, for any business to be successful, you really need to understand your finances. So we're going to get into a great discussion and hear from a great presenter about how to build out your financial model and understanding costs. And Robyn Chin is tonight's facilitator. And first thing I'm going to warn you is don't let her youthfulness fool you. She is an experienced financial leader. She is also too a CPA, an MBA, and a PhD. So she's well accomplished and very experienced, and she's going to give you, a lot of great insight on really how to structure your company financially. But before we get started, as we always do, we have some housekeeping that I want to share with you. Angela shared a few about, already starting as of today, we started with, prior to this event, opening up the breakout sessions prior to the 4:30 workshop activity for participants who are attending the events, connect one-on-one, learn more about each other, and network. We know that's often missing in doing these types of engagements virtually. So we've heard you, so we created that opportunity for you to connect to 3:30 to 4:30. We're doing it, Angela? 3:30 to 4:30 every Thursday prior to the Onramp workshop. In addition to that, the pitch competition will be on July 8th. July 8th, and the winner that night, again, will be receiving $5,000. Eligibility for that event begins with having you attended at least 6 of the 8 workshops that we have scheduled. So that's going to be a requirement. There are going to be additional requirements and submissions necessary to apply for the pitch competition. We're currently finalizing that, and we'll be announcing what they are in the next few weeks. Also, too, I think tonight we're actually closing enrollment to Onramp. Is that correct, Angela?
It's correct. We're closing enrollment to be eligible to pitch, but anyone can always come. It's open and free to the public.
Yes, exactly. So the program itself is open enrollment, but to be eligible to pitch tonight would be the last chance you have to enroll. In addition to that, let me see, breakout room, startup roundtable immediately follows, as we say every week. Attendance is encouraged, but is not mandatory for participation in the program. And as usual, before we start with our workshop from Robyn Chin, we like taking a poll to get a better understanding and get your feedback on how you're feeling about the startup community here in Philadelphia, as we here at the Science Center look at how we continue to strengthen that and be a value-added partner in this ecosystem. So Angela, what's tonight's poll?
So we're having some technical difficulties with the poll, so I'm going to have to bring it at the end, and I apologize, but we'll do it at the end of the session.
Our apologies, folks. We're going to launch the poll at the end, but please take a few minutes. We'll wrap up a few minutes early and allow you to collect that data, because that's important for us as we look to continue to improve the program. So without any further ado, again, I'd like to introduce our facilitator this evening, Robyn Chin, who is someone that I know very well and have retained for a number of ventures that I have been with, where she has come in and been an interim controller as well as financial leader in institutions that I have been involved in managing and running. So Robyn, the show is yours.
Okay, thanks, Tom. Thanks for that wonderful introduction. So like Tom says, I've been in accounting and finance for about 15 years now, spanning from all different types of industries, including real estate, which is the majority of my experience. I've been in auditing. I've also have been worked with nonprofit startups and in the education sector. So I spoke with Tom, and we discussed that at the end of this, there is going to be a competition for funding, and so I think that tonight's presentation is going to be really critical when it comes to like that competition and understanding your finances, understanding your numbers. So I prepared a presentation, a PowerPoint presentation, and we will get to the financial modeling. But the way I've prepared the presentation is we're gearing up to the financial modeling. So this is probably MBA 101 in like an hour. I'm touching on a lot of high level topics, and that hopefully maybe we can do MBA 102 and 103 and we can drill down more. But for business startups and just for beginning entrepreneurship, there are certain aspects of finance and accounting that I believe it's very critical for you guys to understand. If you guys have any questions, you can type them in the chat box. You can like throw those little symbol things up, and I will try to answer them to the best of my knowledge without going down an accounting rabbit hole. And so do you guys, let me see if I can share my screen now and I can start the presentation. Okay, I'm able to share my screen. Let's start this slideshow. Okay, so today's, and Tom, I'm assuming you're going to field the questions if I had keep an eye on the chat box.
Angela will.
Or Angela. Okay, perfect. Okay, so we're going to jump into financial models and cost structure. I'm going to assume everyone has probably no knowledge of accounting. As business owners, sometimes it's difficult to have a grasp on the actual accounting and finance of the business while you are trying to like master the actual business that you have on hand, whether that sometimes it's restaurants, sometimes it's a education nonprofit startup, sometimes it's a real estate startup. The business owner is usually focused on running the day-to-day business, but understanding basic financial elements will be very important in taking your business to the next level and also getting funding. So the course objectives that we have right now is understanding types of business structure, right? And this is, I know Onramp has another program where we'll delve more into business structures, but in order to understand the accounting and the forecasting, having a high level understanding of business structure is important. We'll jump into conversations about accounting, understanding your primary financial statements, business strategy, and we'll go into why that's important in all of this, financial forecasting and financial analysis. So MBA 101. Okay. So there are, in the startup world, there are usually 3 types of business organizations. So in the real world, there is probably 4, maybe 5, but in the startup world, though, what I want you guys to usually, what I've seen and focus on are proprietorships, partnerships, and LLC, right? And so usually when you're just starting out, you're starting a company, most people start out as sole proprietors. And the sole proprietorship, there's advantages to the sole proprietorship. It's easy in organizing. There's really no cost in organizing it. But the disadvantages is that you're using your own resources, right? So you're using your own money to fund things, and there's unlimited liability, right? And so with the sole proprietorship, you're not forming any legal documents. If you are, let's say, a consultant for a company, or you're doing work for an organization, you're a sole proprietor, you produce a W-9 with your own social security number to the organization. That's how you would get paid, because you are the business as a sole proprietor. There's another type of business entity, which is a partnership. Very similar to sole proprietor, but you are in, like the name says, partnership with someone else. The beauty in partnerships is that you can pool resources together, and by pooling resources together, you can accomplish more. The disadvantage to the partnership is the same disadvantage that you have with a sole proprietorship, meaning there is unlimited liability. If something goes wrong, then you are solely responsible, you and your partner. So the next form of business that most people usually start when they're starting a startup or a new business is an LLC, right? A limited liability company. And the difference between the LLC and the other two, the partnerships and the sole proprietorships, is that the LLC is recognized as a legal entity. So you are separate now from this business that you just started. The advantages to doing that is that your personal assets are now separated from the business assets, and there's also business profit and loss that's passed through to the ownership of the business, right? So the disadvantages with an LLC is that it does have a limited life, so you do have to refile again, and as opposed to like a true corporation, you can't raise money via stocks and sales and things like that. Another disadvantage, which isn't really a disadvantage, but some people may look at it as a deterrent, is that you are required to do certain filings. You are required to have organizational documents. You are required to be in compliance, right? And so since most organizations that are startup, they usually go the LLC route, you now become responsible to be compliant. When you have this responsibility to be compliant, this is where having an understanding of accounting comes into play, right? You're now responsible to stakeholders, you're now responsible to the state, you're now responsible to make sure that you're filing the necessary documents, right? And so what is accounting? Accounting, the technical definition: recording, analyzing, interpreting, communicating financial data. When you are now an LLC, because you have to be compliant, you have to be able to communicate the financial data of the organization. Why is the accounting important? It gives the business owner an understanding of the status of the business, to fulfill responsibilities to the stakeholders, and once again, very important for compliance purposes, right? And so do you guys, I guess I can ask you that, does everyone know what a stakeholder is? Or you can just throw that in the chat. Like, anyone can define what a stakeholder is and throw that in the chat. I can't guarantee any prizes, but perhaps Tom can, for those who answer correctly and the fastest. Let's see, who do we have? Someone with an interest in the outcome of the venture. Perfect. I couldn't have said it. A stakeholder is a person. Oh, we have a fellow CPA here. So Benjamin, you can jump in and correct any mistakes that I make in this presentation. My fellow CPA, Benjamin, that's correct. A stakeholder is a person who is affected by business operations. Exactly. So who needs to understand their finances? The stakeholders, right? And so a way that accountants in this day and age make reporting a little bit easier is by utilizing software. And in my experience, so like I said, I've had experience in real estate, I've had experience auditing, I've had experience in service-based business, I've had experience in the education sector, and in all of these different sectors, they have their own proprietary software, right? So in real estate, they have a software called like Yardi. In the education sector, a lot of schools have a software called like Facts, where they track all of their income from tuition and everything like that. And it just makes the accounting very easy. The software is usually desktop-based, web-based, or cloud-based. In my experience, having, especially like in this virtual world, having a web-based or a cloud-based software has proven to be very beneficial. With the desktop version, usually have to be like within the server of the organization. A web-based or cloud-based version, anyone can access your data. So as a startup or a new business owner, if you would like to get a second opinion, or you would like an outsourced accountant to look at your data, it would be easier with the web-based or cloud-based version, right? With this accounting software, we're able to provide financial reports and statements. Like I said, we're able to collaborate with other stakeholders that can have viewing rights to your data. And like back in the days, right, when accounting first started out, they used to do accounting with like paper and pen. And I don't really understand it, but with the use of software now, your data is secure and protected. So that's like another perk to really invest in a good accounting software system. So that's something that I would suggest, as we talk about forming an LLC and being compliant. That should be the next thing, is to understand your accounting needs and invest in accounting software. Yep. Software makes things easier until it doesn't. And at that point, that's when they call the CPAs. Shameless plug, Benjamin or Robyn. so if you're in like, and like I said before, the business owners, your main focus should be running the business at hand. That is what you do. Accounting needs, I would really think you should consider outsourcing it. But you should, even if you outsource your accounting, you should still have a basic understanding of the reporting. And that's kind of where we're gonna go next. So there are three primary statements, right, as a business owner that you should always understand. You should understand your balance sheet, your income statement, and your statement of cash flows. The balance sheet is what is the company's current financial status. And what, we can throw this in the chat too. Why is it important to understand the company's current financial status? The income statement provides you with information about the operating results for the current period. So your revenue minus your expenses. What is my bottom line? What profit am I making? As a business owner, we can throw that in the chat. Why is it important to understand what your profit is and what you've made for a specific period or a specific month, right? And statement of cash flows. How are you obtaining cash? How are you using it? The statement of cash flows becomes a very important statement. It's usually Really, like the statement people, we don't really put that much emphasis on, but it really becomes a very important statement when we're talking about getting investments, and an investor or a stakeholder reading that statement and understanding how your business is generating cash. And we'll delve into that a little bit further. It lets you know how profitable you are or taking a loss. Correct. And understanding how profitable you are or taking a loss, or understanding where your targets are. If you don't know that information, you don't understand how to adjust your strategy to meet those targets or to become profitable, right? So you have to understand where your starting point is as a business owner. And so I'm going to try to run through, this is not MBA 101, this is going to be accounting 101 for a second, but I really think it's very important, I can't stress this enough, for the business owners and the startups to understand this, these three statements. Okay, so your balance sheet is a list of the assets, a list of the liabilities, and the owner's equity as of a specific date. As of a specific date means it's a running tabulation, right, of what you have as of when the company started. So examples of your assets are cash, property, equipment. How much cash do I have in the bank? What's the value of my property? What's the value of my equipment? Your liabilities are things that the company owes, right? Or obligations of the companies. Who do I owe? What vendor is going to call me because I haven't paid them? What bank did I take a loan out from that I need to make interest payments on? Things like that. And then your owner's equity or your net assets is pretty much what is the value of that company, right? So you have your assets, the things that you have, the cash, the property, and then you have your liabilities, right? People that you owe. And if you subtract what you have from what you owe, that's pretty much what your owner's equity is, right? That's where your value is, right? That's what's left over. So when you guys are looking at your balance sheet that you prepare, or your accounting software prepares, or your accountant prepares, understanding, looking at least at your total assets. This is the value of cash, property, understanding who you owe, and understanding what the company's net assets are, and asking questions around that, very important. So I pretty much went over this. Okay, so this balance sheet I pulled from the internet somewhere, but I thought it was very simple enough to give you an example of what to look at, right? So if I was a business owner, I want to see my cash. I would find my cash on the balance sheet. My accountant prepares this, my software prepares it. I'm looking for my cash. How much money do I have in the bank, right? I am looking to see what my total assets is. How much things of value do I have, right? So I'm going to look at that line. I am going to look at my liabilities line. How many people do I owe? How much do I owe them? Are these things that I owe right now, like accounts payable? Like, are vendors going to start calling me? Do I have enough in assets to cover these things that I owe, right? So I'm going to look at my liabilities line. And then I'm going to look at the value of the business. So this business it says Inc., right? So I know it's a corporation because it says Inc., but I also know it's a corporation because they have stock. So this is not an LLC, right? And so the stock here tells me what value the company has. So the things I want to look at: cash, total assets, total liabilities. If you want to really get in detail, you may want to understand when your liabilities are due, what they are. Can you space them out and can I wait and pay things? Can I not? Your accountant can probably help you with that. But those are on the balance sheet. I think those are the most important things that you should always know. So that's statement number one. That's very important. Okay, the second statement that's very important, your income statement. So your income statement is a summary of your revenue and your expenses for a specific period of time. Specific period of time just means for the month, for the year, for the 3 months, for the 6 months. What are all my revenues? What are all my expenses? Your revenue section is usually what goods were sold, right? How you're generating revenue, or what services were performed. Your expenses are costs. In the normal operations of the business, what am I spending money on, right? And so understanding that is very important. And the accounting equation for this is your revenue minus your expenses is going to give you your profit. Right. And so the balance sheet, the accounting equation, this is a little bit more detailed, but the accounting equation for the balance sheet, your assets minus your liability is going to give you the value of what your organization is, right? So that's the balance sheet. Income statement, revenue minus expenses. This is what I'm making. So we talked about that. And so I just pulled, this is Microsoft's corporation. I just thought this was interesting. This is their income statement, and this is like in the millions. So meaning if you have to add another comma and 3 more zeros to really understand what their revenue is, right? So in 2011, very, very long time ago, their Microsoft's revenue was for the 3 months ending December 31st. So this is only a 3-month period, $20 million, right? Their expenses were $5 million on cost of revenue. So that means that was expenses related to however they generated revenue. Maybe it was like factory things, but in order to generate 20 million in revenue, they spent 5 million in cost. Their research and development cost was 2.3 million. Their sales and marketing costs, 3.7 million. General admin costs, 1.2 million. So their total operating expenses was 12 million. Their operating income was 8 million. And so we don't really have to understand this because we're like, and we're a little bit smaller, and we're not Microsoft, but other income, Microsoft gets other income from somewhere that they're not generating revenue on. Maybe maybe investment income, but somewhere they get other income or something, right? And so then you come down to the income before income taxes. Microsoft supposedly paid 1.6 million in income taxes. I doubt they paid that, but they made a provision for that. They assumed, based on the tax rate, that they should allocate 1.6 million in income taxes. So Microsoft's total net income, when you factor in their revenue and all of their expenses, was 6.6 million. This is a high level example, but as the business owner, your income statement focus on how much revenue am I making? What is my main expense cost driver? What is my bottom line, right? And you should be able to just kind of tell. I mean, we'll go over ratios. If your bottom line is drastically different from what your sales revenues number is there some way where you can reduce cost, right? And if you can't reduce cost, is there some way you can rethink your strategy to increase revenue, right? Because the bottom line is really what's important. Hold on, let me check the chat. Oh, 20 million. Okay. Yes, sorry. Is cost of revenue include the cost to advertise a service? I think actually cost of revenue is just All right, so if I had a manufacturing company, right, and my company produces T-shirts, right, and so my main revenue driver would be the sale of T-shirts. Cost of revenue would be the factory workers. It would be anything that is associated with having to produce that T-shirt. So anything that's associated with you having to get to that revenue, directly associated, that would be what your cost of revenue is, or your cost of goods sold. Right. Okay. So the last statement that's very important is your cash flow statement. And so the cash flow statement is a summary of cash receipts and cash disbursement for a specific period of time. How did the company receive cash? Was it through your general operations? Was it through investing? Was it through stocks? How did the company use this cash? Did you use it on operating things? Did you use it to invest? And yeah, so there are three categories. We'll go into it: operating, investing, financing. And those are the three categories the use of cash would fall into. So ways that you can get inflows of cash to business: goods or services, selling assets, investment by owners, ways cash goes out of the business: operating expenses, purchasing investments, paying owners returns. And so when you guys receive a financial package with these three statements, right? Your statement of cash flow, your cash is going to be in three different buckets, right? So it's going to either be in operating, it's either going to be investing, and it's either going to be in financing. So in the operating section, you'll see a movement of cash from cash receipts and payments from the general operations of the business. In the investing section, you'll see the movement of cash from acquisitions and sales. And in the financing, you'll see the movement of cash from borrowing, cash withdrawals by the owner. And so this is an example of a cash flow statement. So if I were an investor, the reason why I would look at the cash flow statement, and as a business owner, why this is important to you, is if I understand if a business is a startup company, usually a lot of the time they're not going to really be generating cash in the operating section, right? So I'll get an understanding. So if a business comes to me and they say, you know, we're in the first year of operations, I'm going to look at their cash flow statement, and I'm going to see how profitable or how much cash has been generated in operating. Now, if a business says, yes, we have like 15 years of history, we've been in operations, and I look at the operating activity and there hasn't been much cash generated from the operating activity, that is kind of a red flag to an investor, right? Why is it most of your cash coming from your business operations, right? Because a company can show on their balance sheet that they have a substantial amount of cash, but what the cash flow statement tells you is how they've been generating that cash. So I can have a substantial amount of cash because I've been selling investments, right? And so that has nothing to do with how I'm generating business within the organization. That just has to do with that I'm selling things and now I have cash. So that doesn't tell me how you're running the business. Right? And so this is where this statement becomes very useful. And as the business owner, if you're presenting a package for funding, understanding that the investor will look at your cash flow statement to understand what life cycle of the business you're in. And so for this cash flow statement, we see that this business has garnered $29,000 in cash for the period. Where did that $29,000 in additional cash come from? 90,000 of it came from operating activities. So I know that this is a solid business. They have most of their cash came from doing business. And I see that their financing went down. That means they probably paid off a loan or something, or paid out money to an owner. So they think that they're in a good position, I guess, to pay this money out. And so those are the questions that I'm looking to ask as an investor. Why you, as a business owner, you should also know this. So those are the three most important statements in your accounting package. This can be produced by accounting software or by an accountant. Okay, so now that we understand, Robyn, what those three important...
Hey, Robyn, can you hold a second? Why don't we just ask the group, based on where you are right now, especially around financial statements, which are really key in really managing a business effectively. Are there any current questions from any of the current attendees, or any thoughts or additional feedback or insights or specific issues they might be dealing with currently with managing their business, especially how do you better utilize their financial statements to really be more strategic about how they operate? Everybody's good so far? No questions jumping out? Somebody just put something in the chat. Oh, any software recommendation?
Any software recommendation? So definitely as a beginning business, I always recommend Quickbooks, right? Because Quickbooks is very easy to use. It's a cloud-based software where it's relatively inexpensive. But if we are going to specific industries, I would say that there are proprietary softwares for industries. So I would need to understand what type of industry, and then you can do what's called the needs analysis, where you can do like a Google search of different software packages, what they offer. But for any business starting up, QuickBooks works.
Yeah. Any
free templates.
Yeah, from Gregory was free templates. Do you have any to recommend sites?
Any free templates. So Microsoft is actually pretty good. Microsoft Excel is actually pretty good with giving you a template for your balance sheet, for your income statement, for your cash flow statement. But I would recommend getting QuickBooks software. The basic version is $10 a month, and you're able to link QuickBooks to your business bank account and download all of your transactions from your business bank account into QuickBooks, and then classify things into different buckets, different expenses, whether it's phone expense, rent expense, and then you're able to generate reports from QuickBooks.
Somebody says they use QuickBooks, they find it quite pricey. I guess it depends upon the version that they have.
Yeah, they do have different versions. They have a $10 version that's very basic. They have a $20 version that's more advanced. There's a $75 one. So it all depends on what your company needs are.
Yeah. And also too, would you suggest that that's a discussion that they should be having at least with their tax accountant if they don't have an accounting relationship or some type of financial support for their ongoing needs, especially if they're managing their finances themselves?
Yeah, so your tax account, as someone said, your tax accountant is going to recommend probably recommend for a smaller startup QuickBooks, but I would also say as that can also fall under the realm of the business owner to understand like the industry that you're in, what software is relevant for that industry, because QuickBooks may not, like for example, in real estate, right? We don't really use QuickBooks software in real estate. We use a software called Yardi or MRI, and they are specific for tracking certain transactions that happen in real estate, right? And they're just the known ones. So if I did a Google search for real estate software, then those would be the ones that come up. And so as the business owner, just doing a search and to understand what available software there is specific for your business, if it is a specific type of business. Hold on, let me.
There was a question about what are your thoughts on Wave?
I'm actually reading through the chat. Any major differences, things to pay attention to for private versus nonprofit entity? So as far as QuickBooks goes, there is a nonprofit sector or a nonprofit application in QuickBooks. The differences between nonprofit and private is what they call things, right? So instead of profit, you have net assets. You still, instead of a balance sheet, you have a statement of financial position, right? But it's still pretty much the same general concept. The way QuickBooks works with nonprofits that's really good is that it allows you to track things by like classes and things, because in the nonprofit world, once you get a lot of funding, sometimes they're specific to certain programs, and having the ability to like track that revenue and then track expenses that specifically to those programs becomes very helpful when you have to report to funders. So that's one of the major things that's like different in nonprofit is that tracking mechanism per grant. You have to have a good grant tracking mechanism. As a startup that has been developing the service for over 2 years but have not sold anything, we have survived through personal funding. That was the startup point of my statements. I would say you should start your statements now, right? Because when you, at some point, you want to be able to provide, something to outside funders or outside funding sources, right? And so that it would be helpful if you had like a system generated report, even if you're not showing any type of revenue. And I know, so I'm not a tax expert, but I think that there is like some tax rules or tax write-offs, even for startups. If you're not making any money, that you're able to write off some of those costs of starting up the company. So all of that work that you've been in development for the last 2 years. So being able to have a system that tracks it becomes important for that purposes. Do you know? QuickBooks does have the ability to work retroactively. It does go through, you can connect it to your bank statements, and I know it goes at least a couple of years back. I'm not sure if it goes more than 2 years, but I do know that you can do it retroactively. I am not sure what Wave is. I'm sorry. I'm not familiar with that software. Okay, so someone said that you can amortize initial investment. So being able to track it becomes very important.
Oh, Robyn, can you explain amortization so everybody understands?
So I'm an accountant, but I'm a tax expert. So I'm not giving tax advice here, but pretty much the cost that you spend over over the life of like developing your product, that can then be spread over 15 years of revenue generating. That becomes important because now you have costs that offset your revenue that comes in, and now your bottom line decreases. So that helps you from a tax perspective. You're paying less money on what the income that you're making, but these are costs that you have occurred in the beginning startup stage that you get to spread over the life of the business to reduce your tax liability.
Oh, good stuff. Good stuff. Okay, so why don't we keep going now?
Okay. No problem. Let me minimize that. Okay, so let's jump into business strategy, right? So business strategy is any type of action, decision that the company takes on to put themselves to be in a competitive position or to be a leader in the marketplace, right? So understanding what your business strategy is important because that should inform how you forecast. That should be like your blueprint to the goals that you set for the organization. There are two main types of business strategy. And those two main types of business strategy are your low cost business strategy and your differentiation strategy. Right. And so a low cost business strategy is, as the business owner, you have a product or you have a service and you want to be the lowest cost or at the lowest price point for that service. Right. And MBA 102 or 103, we can delve into like how you become the low cost leader, but just understand that that's a business strategy, right? You're the low cost leader. The other strategy is a differentiation strategy, and that is that you have this unique product. You're going to charge a premium price for this product because it's so unique and the market is going to pay for it. You have a specific customer base that's going to be attracted to this product. Those are the two main business strategies, right? And so here are some examples of those business strategies. So this is called what we call a 2x2 matrix, right? So in the business world, everything goes on 2x2 for a comparison. And so here we're comparing cost and uniqueness to the market that you're trying to attract. So an example of a cost leader or a low cost business strategy is Walmart, right? You go into Walmart, they said all the prices are dropping all the time. Everyone can come into Walmart and we have the lowest prices. So they have a broad target that they're trying to attract, and they have a low cost, they're the cost leader. That's their strategy. Now we go to someone like Nordstrom, right? And so Nordstrom also has a wide market that they're trying to attract, but they do have a more unique products, higher brand names than Walmart. But they're targeting the same large base, but their competitive advantage that they're trying to target is very different, right? So then you have a store like Dollar General. And Dollar General is very, their target market is narrow because you don't find Dollar Generals just everywhere. They are very specific in location, but if they are in your location, you can go in there and you can find like things that cost $15 at Target, it might be like $8 at Dollar General. And there's a reason why they're able to do that. There is a supplier network, there is a lot of thought that goes into that strategy. And then their uniqueness and narrow target is like Anthropology, right? So I don't know, there are ladies in here, but Anthropology, they sell like really, not weird, but like unique women's clothes, right? So not everyone's going to wear it, but it's cute, you know, and for that type of market that they're trying to attract. And so Anthropologie decided that the business strategy that they're going to take on is going to be a unique product, and they're only going to focus on a specific niche of the market. And so as owners and bohemian clothing, exactly, that's exactly what I would call it, bohemian clothing, and unique and pricey. And they're unique and pricey because they have a specific market that they're trying to attract. And that specific market is looking for that unique product that they want to sell, right? So does somebody sell Zoom-friendly clothing? No, I don't know, but maybe we can invent it, right? So if we were selling Zoom-friendly clothing, what would be our competitive advantage and what would be our market, Zabe?
Zoom-friendly clothing might be a really nice front with an open back so you stay cool or stay warm, would repel coffee spills, would absorb sounds and bad jokes and off comments.
I think there's a broad market for that, actually. I think the target for that is very broad. And I don't know, maybe we could sell it at a higher price point. It does sound pretty unique. So, but as a business owner, when you're thinking about your product, you should be thinking about it in those two aspects. Is my target broad or narrow? Is it specific, or am I selling my product, or am I offering my services at low cost, or am I offering it a unique product? So I will offer it at a premium cost. This becomes important in forecasting. So now that we have an understanding of like what your business strategy is, right? How you're going to price things, who you're going to reach, then we can start thinking about forecasting, right? Why is forecasting important? It's resource allocation and planning. It gets everyone kind of on the same page of understanding what needs to be done. It gets the managers and the owners on the same page of where the price points of certain things need to be. And yeah, it encourages managers to consider problems before they arise, right? So forecasting becomes very important after you understand strategy. 2 ways of forecasting. MBA 101, top-down forecasting, bottom-up forecasting. So this is for a bigger organization. I didn't want to just have this very small. Maybe there are some participants in here that have a larger organization. Top-down forecasting and bottom-up forecasting, and we'll talk about bottom-up in a second. But top-down forecasting is pretty much the owner or the managers, they decide what the budget is for the entire organization, and then different levels of the organization, they get directives from the managers that tell them how much they should be spending, what their revenue targets should be, right? And so what do you guys think is, and you can put this in the chat, like, is an advantage of doing top-down forecasting, and what might be a disadvantage of doing top-down forecasting? Detached from realities, right? I like those answers. Those are the exact answers I have in my notes. So those, is money a solid or a liquid? Most young people feel that money is a solid business cash flow. That's a very interesting question. I would say money has to be liquid because it has to flow through, the different entities of the business. Like you should always try to find ways to invest or use the money, right? And it's like, it's a tool or a resource to make more. So I would say money is a liquid.
It's also a situation where you could have fantastic solid equity money, like you got a huge amount of receivables and you got equipment and all this hard stuff. But if your clients aren't paying you and you got to make payroll, it becomes the real problem as cash flow and as a liquid. It's like the blood that flows through your business.
Yeah, and so like that goes back to our opening statements of not only understanding your revenues, but also understanding your cash flow and understanding your cash flow statement. That becomes very critical because what sometimes happens, right? And this is a little bit deeper level of accounting, right? Accounting has two systems, like accrual system and a cash-based system. And on an accrual system, right, we can record revenues of the business even if we haven't gotten the cash in yet. So on paper, right, you can look like your company is making a lot of profit. You're able to record the revenue once you complete the service. But a lot of times, the startups, they go out of business because they don't receive the cash in. So on paper, they've made a lot of money, but operationally, they can't function because they haven't received the cash. So that's a good point, Zabe. And Hakeem, Broderick, Shelly, those are all the same ideas that I have. The advantages, you stay out of the weeds, it's less time consuming. Disadvantages, the managers are detached from the budgeting process because they are not involved. Okay, and Tammy, I like what you said about bottom up because that was going to be my next question. So most businesses use a bottom up strategy where they would ask the individual managers that are responsible for a specific department, for a specific unit, to come up with a budget, and then the budget is rolled up into a master budget. The bottom up strategy, yeah. How about both and collaborate? I think both is, I think that you would have to start with bottom up because the top down is where the execs just give you a number and say, figure out what to do, right? I feel like if you start out with bottom up, then you can probably have more of a collaborative debate with, yeah, right, exactly. You guys are good, yep. Yes. Good stuff in this chat. You guys making this easy for me. Okay, so we want to talk about two different ways that you budget now, right? So there are two different ways to budget. There is what is called an incremental budgeting and a zero-based budgeting. The incremental budgeting is mostly what we use when we're doing financial forecasting. And that is pretty much you're having historical data and you're adding or subtracting percentages based on your best estimate. For example, if revenue has increased 10% every year since you have been in existence, then when you do a budgeting, then you would then forecast revenue to increase again every 10 years to kind of simulate what it has been in the past. A zero-based budgeting, you definitely would use zero-based budgeting when you're first starting out. But some organizations like to use zero-based budgeting even once they have been in business. And it's kind of just like a reset of understanding, you know, what they think that the operation should be. and not using historical data to drive it. And so 95% of the organizations that I've worked with use in incremental budgeting though. It's also less time consuming. When we're forecasting as a business owner for your organization, and Dave and I touched on this, right, is there should be 3 types of forecasts that you do, right? You should do an operational forecast, and the operational forecast is you forecasting what you think your revenues are, what you think your expenses are going to be, and understanding what your profit is. Your capital forecast is kind of your funding forecast, right? You need large capital assets. Then what are those capital assets? When will you need them? And who can you go to tap into to get those capital needs? And then a cash budget forecast. So if you are going to be a receivable collecting company, like most companies now are, and not like cash on demand, then you need to forecast when do you think your clients or when do you think your customers pay, and forecast the cash that's actually going to come in to understand, to make sure that you can meet your operational needs based on the cash and the timing of when it's coming in. So understanding those 3 budgets is very critical when building your forecast. Okay. So what I'm going to focus on for the next couple of slides is your operational budget. When you are building an operational budget, and there's various reasons why you do that, right? You build an operational budget because you need to understand what money your business is going to be making by the end of the year. You build an operational budget because when you go to any funder to ask for money, they want an operational budget. And you build an operational budget in the beginning to even understand if this venture is a worthwhile venture. Sometimes we have like these ideas in our head and we think like, it's so great, I am going to invent Zoom clothing and it's going to be a hit. And then you do the budgets and you realize the cost to make repellent suits are like far more than what someone is going to end up paying for it. And then Dave has to say, it was a good idea in theory, but you know, the operational budget is telling me I can't do this. So those are the reasons why it's very important. There are 2 elements to the operational budget: the revenue element and the cost element. Okay, so the cost element is your costs are made up of fixed costs and your costs are made up of variable costs. Very important to understand the different characteristics of the cost, right? Fixed costs and variable costs. Does anyone, can you guys throw in the chat why you think it's important to understand if a cost is fixed or variable? Oh, I kind of gave you guys an answer in here. I should have took it out, but forget it, because I gave you, well, an answer besides what I have on the slide. Variables change and impact expenses, correct. There's certain industries switch to net zero based budgets with the pandemic. In my experience, so I have about 5 clients that I'm actually doing budgeting now for. We haven't switched to a net zero based budget. We have still used historical data, but we've adjusted for last year's like increase or decrease in revenues or increase and decrease in expenses based on what the previous year is. So we just put last year as an outlier in certain costs. Like for example, like one of the schools I work with, they spent $80,000 on tents to have the classrooms outside. So when we're budgeting for this year, we're taking out that tent cost, but we're not starting completely from zero. Yeah, and so it is easier to control a variable cost than a fixed cost, and that's very important to understand, right? If you have a very high fixed cost organization, there is minimal room for adjustments to meet your profit, your profit or your bottom line. Variable cost, you can adjust up and down, but if you have a high fixed cost organization, it becomes difficult to make adjustments there. So minimize fixed costs as much as possible. Even if that office space overlooks like the most beautiful mountain or river in the entire world, try not to sign a $20,000 a month office space lease, because that becomes a fixed cost and non-negotiable, right? And even, you know, the view may be beautiful, but then look what happens now. No, everyone's remote, so. Okay, and then so the other part of that, right? Forecasting your cost, forecasting your revenue. Three ways to forecast revenue. You can do a mixture of this. Usually I don't do like one or the other. I usually do a mixture of this, but it's, you have a cost of something, then you do a markup. You do some sort of market analysis or competitor-based analysis. You base your revenue on what your competitors are charging, and you scale up and down depending on how you view your product. And customer willingness to pay based on market analysis. So that is like Apple, right? Apple is not doing a cost plus markup. They're not doing a competitor base. They know that they have a premium product. And this ties back to strategy, right? Or uniqueness and strategy. They have a premium product, and they will price it at what they believe the market will pay. And that is how they do their revenue forecasting. Okay, all right, so I think before we hop into the last section, does anyone have any questions on like cost, on revenue pricing, on operating budgets, the capital budgets, the cash budget? I was trying to read the questions as I go along, so I think I may have gotten them. Okay, so the next step after we do a budget and we start going through the year, we budgeted things and now we're up and running, we're operating. Critical thing to do as an owner is something called variance analysis. Why? Why do you guys think that you would have to do a variance analysis? And I should tell you what a variance analysis is, right? So a variance analysis is more accurate in the future, good. But variance analysis is comparing what actually happened to what was budgeted. Safeguard, but figure out what's shrinking, why you may need help. To explain stakeholders why you didn't meet your budget. Yep, trend.
Make sure you don't go over your budget.
Yes. I'm not sure what CYA means. I'm joking. I know. But yes, exactly, right? To understand if you do go over budget, why? Why did you go over budget? For example, in revenue is usually made up of two components, right? It may be made up of your price number and your sales volume. So if you have a revenue target, your revenue target, you budgeted it based on price and sales volume. So now if you're below that, you have to understand what went wrong. Did I not sell as much as I thought I was going to sell? Or was my price point too high or my price point too low? And now I can make adjustments, right? And so, California Youth Association. And so And so your variance analysis, I try to tell a lot of clients that this should be done on a monthly basis, right? You don't want to span a 6-month period or a 9-month period or a 12-month period to do your variance analysis, because making an adjustment becomes too late. If I'm doing a variance analysis on a month-to-month basis, I can then investigate overages, underperformance, and then make adjustments in that specific period. Two couple of ways to do analysis: a horizontal analysis or a vertical analysis. Horizontal analysis is just comparing your financial position over time. So you can do a year over year, you can do a month over month, but it's over a specific time. Vertical analysis, you are comparing what's happening versus a base amount, so versus your budget. So I also suggest doing both of these. And once you have software, this becomes easier. I want to know how I'm doing. What's this month? May. I want to know how I'm doing in May 2021 versus May 2020. And in a lot of the budgets that I'm doing, there are huge variances. Can someone guess why? May 2021 is very different from May 2020. Pandemic. Yep. No, they're drastically different. So a lot of my variance explanation is COVID or pandemic or shut down or something. And then my vertical analysis, I have a budget that I created. I want to know why my actuals are different from what my budget is. Okay, so here's an example of what a variance we
Sorry, I think we lost her for a minute.
All right, let's give her a second. And we had some good questions in the chat.
Sorry, guys, I was lost, but now I'm found.
Oh, there you go.
Glad you're back.
Okay, so what do we have in the chat?
We had a couple questions in terms of, are you submitting a budget as a formal document to outside sources? That was one, and actually came up twice. As a planning tool, it might be appropriate. Okay.
Okay. And
really about budget
yeah,
uses.
and I like that Ben said might be appropriate. And I don't think that I would, because even in that case, I wouldn't want to pad the numbers in that case, right? You want to get a true understanding of where you are. If you're submitting that document to outside sources, but even as an internal tool, you need to understand that. Yeah, and I know in like the nonprofit world, even if you are submitting a budget to an outside source and they are giving you grant funding based on that budget, and you deviate from that budget, that you'll only get 1 year of funding, because because you then become a volatile organization, and they may think you don't understand where your budget truly lies, and funders are then a little wary of funding a situation like that. So you want to be very honest. No, I don't say. Yeah, I don't say I would think there's any situation where you would pad the numbers. Like, it wouldn't be even if you have an educated reason, then it's really not padding, right? It's your honest, true estimate of why you're doing it. Yeah, so this is Acme, which is a supermarket in the Northeast, and I'm sure this is probably in the millions. So they forecasted ending the year with 5.4 million in net income. They actually ended the year with like 7.5. So somewhere here, right, there was a variance that contributed to that. And as an accountant or a business owner, you would then analyze, okay, where was the variance? What contributed up to us being an additional 2 million over? Should we have budgeted higher? Things of that nature, right? So in this one, I would say, just looking at the percentages, product sales, 5 million for product sales, they were over. And so they kind of, most of it is like they kind of just did better in sales in the supermarket. And then I would say, like, okay, why did we do better in sales? Was there something going on? Should we plan in the future for having sales numbers at 19 million? Or was there just a pandemic and everyone was home, so everyone was buying groceries, and we shouldn't really factor that into, like, our budget process in the future? So that's kind of when we analyze a variance report, what we're looking for. And as a funder, that's kind of what we're looking for too. You told us that you were going to get 10 million in grant revenue. So we decided to give you a grant for 1 million. You ended up getting, I kind of went out on a limb and gave you $1 million based on the fact that you said you were getting 10 million, but now you didn't. So as a funder, that's what I'm looking at. And I think we are almost complete, but just one last thing I kind of want to touch on. When it comes to your statements and your budgets, there are different ratios that funders or banks or stakeholders look at, and it just gives them a quick idea of what's going on in the company. The ratios, the debt ratio tells you how much a company has in leverage, right? As a funder, I do not want to invest money in an over leveraged company. So I'm going to, and I don't want Benjamin to answer this question. If I was a funder and I wanted to of the company, which one of the three most important statements would I look at?
Robyn, you broke up. Repeat your question.
I said, if I was a funder and I wanted to understand the debt ratio of a company, which one of the three of the most important statements would I look at? We have the balance sheet, the income statement, the statement of cash flows. I'm a funder. I need to understand what your leverage is. Which statement am I going to ask you for? Woo! I'm a great teacher. I just needed one person to get the answer correct, and I have 3. I have 4 or 5. Perfect. That's good. Yes. You would look on the balance sheet because the balance sheet is where you would have your liabilities and your assets. And that as a funder, that's why I need to see your balance sheet to understand how leveraged you are. If I wanted to understand how liquid you are, I would look in the balance sheet because that would tell me what your assets are. That would tell me what your liabilities are. If I needed to understand how you're utilizing your assets, then I would look at your income statement because that's where I would get your sales number, and I would look at your total, your balance sheet because that's where I would get your total asset number. One question. If I needed to understand what your return on sales would be, what statement would I look at? And I need to understand how much return am I going to get? No, just return on sales, income statement. Perfect. Yep. Because that's where I would find your net income and your sales. And if I wanted to know, so this is the main one. If I wanted to know, I'm investing all of this money, what statements would I look at to understand my return on equity? Income statement is one. Yep. And is there another one? Where's the owner? Perfect. Exactly. So the owner's equity is located on your balance sheet and your net income is located on your income statement. Good job, guys. Good job. Okay. That's all I got, folks.
All right.
Any other questions?
Questions for Robyn? Any feedback? So, great job. Love your energy from Gregory. Oh, your contact, Robyn, your contact information. And again, as I said, when I open up this evening's presentation, it's all about the numbers. And as Robyn has taken you through to help you understand everything from your financial statements to budgeting and forecasting, what is essential for you in terms of building a successful venture is really beginning to get a handle on your financial statements, because as she's pointed out on multiple occasions, when you sit down and you talk to investors, you talk to lenders, and when you talk to debt providers, you talk to equity participators, you know, if you can convince them you understand your numbers, even though you may not be profitable, even though you may be pre-revenue, being able to explain your numbers, give people confidence that you know where you're going and you have a strategy to get there. The key to successful funding is not necessarily being profitable, but being able to tell the story about how you reach profitability, and also to have a compelling reason why somebody needs to invest in you so that you can achieve the projected goals you've defined for this venture. We have a bunch of chats that's just jumped in. And thank you. This is great. Robyn, did you post your information? Do you have it ready to post?
She posted.
Yes.
Okay, great. All right,
we also have our poll question if you want to launch it now.
We do. We got 4 minutes left. Perfect time. So Angela, please, the poll, please, tonight for everyone. So tonight's poll that I need everybody to complete before jumping off or jumping on to the next workshop is, what does the Philadelphia innovation economy need to do to grow the startup ecosystem? What does the Philadelphia innovation economy need to do to better improve the startup ecosystem? And you have a number of options: expand community engagement and networking prospects, provide more partnership opportunities, improve capital investment and funding options, increase training, corporate support, government assistance, contracting possibilities. Please complete the poll before you jump off, everybody. This data that we're collecting is going to help inform us how we improve Onramp to better service you.